This is the Friday, November 27th, 2015 version of the Market Plus segment. Joining us now is Virgil Robinson. Virgil, welcome back.
Thank you, Mike. Nice to be with you.
And we are glad to have you. It's always interesting to have your take on the global markets, Virgil, and how they're impacting American producers. And with that in mind, let's take a look at cotton. That, as much as wheat is a true global market, are we finding some stability in here in the low 60s?
Yeah, I think the market's kind of flattened out, Mike, and if there is such a thing as price equilibrium, I think we're approaching it in cotton. Now, that's not to say we have to appreciate in value over the next several months, because that doesn't appear imminent. There are some harvest concerns here in the U.S. Texas, Georgia, and North Carolina lagged their 5-year average harvest pace, and should weather continue to trouble them, there's the prospect of some field loss and some quality issues specifically in those areas. So that could have an influence on local price, Mike, not necessarily the futures market, because it's a global indicator. But clearly there are some things that could provide some local price improvement in the near future. Globally, one statistic that I just cannot mention is that in the last WASDE report, Mike, there's 347 days of global cotton use on hand. Now, clearly that's not bullish. That's going to keep price advances pretty much in check.
Do you expect to see the U.S. lose some cotton acres here in this next growing season, Virgil?
Yeah, I think some, Mike. But again, there are programs that still support cotton production in contrast to other commodities. So I think cotton acres, while they may come down in marginal areas, will remain fairly stable at last year's acreage numbers, or thereabouts.
Okay. Now, I want to come back, circle around to something you've mentioned on the show, you've mentioned it here, and that's the ample supplies of nearly every commodity out there. Michael in Roland, Iowa is curious, how will weather events, for example, wet spring, late spring frost, hot or dry summer, impact the markets in 2016-17, given the ample supply of corn and beans in the pipeline today?
Yeah, I think, given the price area that we currently reside in, a weather fear or perception of weather concern would have a positive effect, at least on the futures market, Mike. Now, here again, if you have corn under loan, and there's a lot of it being placed under loan, that corn will have to come to market at some point in time. So while we've spoken of late about the strength in the basis because of storing it and because of deferring price and the like, if futures begin to move higher in 2016, the basis will likely offset much of that, Mike, because it is a well-known fact there's a lot of corn yet on the farm.
And now that leads us right into our next question, kind of a throwback question to the one you answered on the program from Cindy. This one's from Marty in Buxton, North Dakota. He's wondering, could you discuss selling the cash corn and beans into a strong basis and then buying calls cheaper than commercial storage? With the low volatility, in some places that's pretty achievable.
Yeah, I think, he's talking about the use of his money, effectively leveraging the use of his money. And given those circumstances where the cost of his call, now he hasn't defined whether that's an at-the-money call, a way out of the money call. He hasn't defined that, so I can't really answer it specifically. But if it's an at or near the money call and you can buy it and buy it cheaper than you can commercially store grain for that window of time, clearly it's a good strategy.
You bet. And looking at, would it be as good a strategy to go, okay, I'm paying X for commercial storage through blank, January 1 or March 1 or whenever, and then just spend that on a call? Or at that point, are we dealing with too many different factors?
Well, you're limiting yourself in terms of time, Mike. In this environment, time is, I think, something that is important if you're in hopes of a significant or a price rise. So limiting your window of time would have risks associated with it.
Okay. Now, you've mentioned a rise in the futures. A weather event could do it. We could see something happen. We've got a question here from Brett in central Nebraska. He's wondering, does December 2016 corn have a chance to make it over 450?
Well, yeah, it has a chance, Mike, if there are a sequence of events that take shape, particularly weather in particular. Certainly that could happen. As mentioned, based on data that's fairly reliable, there's a pretty significant short position in futures, corn futures, by the speculative community. And should they be compelled to leave or cover their short positions, certainly you could push corn futures 35 to 50 cents over a 2 or 3 month period without any significant without any trouble. So to answer his question, is there a chance? Yeah.
All right. Would you, as a risk management plan, wait to market anything until we hit 450? Or do you start putting some in place as we start to climb?
Old corn or new corn?
New corn, looking at 16.
Well, again, I hope they have the opportunity now to put together a budget, Mike. I think fertilizer costs are calculable, seed costs are calculable, so they can do that. And if it meets and exceeds their cost of production, certainly I would begin some type of incremental program at that point in time.
Okay, and that kind of leads us right into our final question for you. This is from Reed in Iowa. And Reed is looking at the markets today with ample supply, prospectively big crops going in South America. And he's wondering, where are the current grain markets headed with our current carryover? Let's assume a standard spring, a little bit of a weather scare in South America, but just ho-hum weather events going forward. Are we on a downward trajectory with these carryovers?
I don't sense that at present, Mike, and I guess how I would address that would be, given tonight's ratio, new crop corn, new crop soybean ratio, it is, in my opinion, slanting towards more corn acres. And I think that's likely to occur. As a matter of fact, I think there'll be more soybean acres next spring as well. So if that assumption is correct, and all those acres yield at, near, or something about trend, we will likely add to stockpiles a year from tonight. It's going to require a significant weather event, Mike, to better align supply with demand, and I can't forecast that.
Right.
I mean, nobody can forecast that.
All right. But maybe we'll get some marketing opportunities into the springtime.
Oh, there are always opportunities. It's just a matter of what are your expectations. And in this environment, to expect $1 recovery in corn and a $2.50 recovery in beans is not likely.
All right. Shoot for singles. Hit singles, maybe not hold out for the Grand Slam.
Sounds like a plan to me.
All right. Well, Virgil Robinson, thanks so much for joining us this week.
Thank you, Mike.
Thanks to all of you for tuning in. Please continue submitting your questions, and we will get expert analysis right to you. Thanks for watching, and have a very wonderful Thanksgiving.